Besides an actual stock quote, so the price of an actual stock today, I think probably the most quoted piece of information about a stock, or the most highly available piece of information about stocks in general, is probably which ones are hitting 52-week highs or lows. So now, and it really depends on how the economy is doing or how the market is doing in general. So for example, stocks hitting a 52-week high price, meaning that it is trading at the highest price today than it has over the last year, over the last 52 weeks. So the total number of stocks right now on the NYSE, for example, that are trading at their 52-week high is 1. Now, the total number of stocks that are trading at their 52-week low, so in other words, they have not traded at a lower price at any time over the last year or the last 52 weeks, there are, as of right now, there are 260. Now, the same type of bias here exists for the NASDAQ. So right now, the NASDAQ, just as I'm filming this, there are no stocks hitting their 52-week high. In other words, there are no stocks listed on the NASDAQ today that are trading at prices higher than they've been over the last year or 52 weeks. And there are 246 stocks that are trading at their all-time lows. So now that we know what 52 weeks are, and of course we get 52 weeks, it's a yearly high or a yearly low. So you'll see these alerts all the time, such and such a stock's trading at a 52-week high or 52-week low. What does that actually mean? Well, it means a couple of things. The first thing that you have to keep in mind is a concept called anchoring. So anchoring is what happens when just individuals, normal people, put a lot of emphasis, in fact a disproportionate amount of emphasis, on a particular metric, and it creates this skewing effect. So what I mean is, if you're looking for a specific number, even though it's arbitrary, 52 weeks is arbitrary. It doesn't have any inherent meaning towards the value or lack of value for a particular stock, but it is something that traders pay a lot of attention to. So when you hit a 52-week high, you'll see traders oftentimes talk about, well, I can't buy this stock because it's at its yearly high. Why would I buy this? It's about to turn around and go down. They're just kind of anchored on this concept of why would I buy stocks at a high? Or potentially, and this is one I'm hearing a lot of lately, if it's at its 52-week low, well, it can't get lower than that. I mean, there's got to be some really rock bottom prices. But is that really true? It's actually not. It's a misconception, and it's all based on this psychological phenomenon of anchoring. Now, this appears in other situations besides the stock market. This is something that we know about, and it's a really interesting phenomenon where just arbitrary numbers become very meaningful for inexplicable reasons. So, does it matter? Well, it does. 52-week highs does matter in a way. In fact, statistically, here's a way that you could test it. If you polled a random series of stocks at random intervals over, let's say, a 10-year period, and you looked at what is their current price versus their high price during that year, you could get a sampling of, well, what typically happens after a stock has hit its high price for a year? What happens over the next 6 months? So if a stock hits a 52-week high, what is the probability that it's actually going to be higher 6 months from now? And it turns out there's actually a statistical probability that it's going to be even higher. And why is that? It's largely because there's some momentum behind that stock. It's really, all we're paying attention to here is trend. So 52-week highs or lows is nothing more than the trend. That's what we're defining. The trend is either up or it's down. Now, in investment, we typically tend to err on the side of the trend, meaning that if the trend is down, we don't typically try to buck the trend for no good reason. If the trend is up, we typically don't try to short that stock for no good reason either. And what you'll find is that this matters quite a bit, because sticking with that trend or anticipating that a stock that's hitting a yearly high is likely to continue up higher is generally a pretty prudent thing to do. There certainly is evidence that would suggest that it is imprudent to try to short that stock, for example. So that would be potentially very unwise. Now, this effect is much more pronounced on small cap stocks versus large cap stocks, for example. It's also something that we have to keep in mind as there are market shocks in the market, such as the one that we're experiencing 2008, 2009, where it really skews the results. So this is something that, this is an average that takes place over a very long term. So we couldn't say that over the last 6 months that this has been true, that 52-week highs lead to even higher prices on average, because it doesn't. It's something that we would say is true over 10 or 20 years with many stocks and many stock returns. So how might we put this into practice? Well, in a normal market, we would do a couple of things. Number one, we don't get too worried when a stock gets up to its 52-week high. If there still seems to be a valid reason to be holding it, we would continue to hold it and disregard that 52-week high. There is some statistical indication that the stock does get pretty volatile at that level because traders get really preoccupied with that particular price. They get anchored to it. So we do get a little bit of volatility there before it breaks out, but it does have a likelihood of breaking out to the upside. The other thing that we have to keep in mind is that these results, whether sticking with the trend, for example, and anticipating higher than average returns by buying stocks at 52-week highs or by investing in or by not selling stocks that have just hit their 52-week high, is something that really only applies over the long term and within a diversified portfolio. So we have to keep that in mind as well. You can't necessarily apply what works on average or over a large pool of stocks just to one stock. So if you see one stock hitting a 52-week high, it's not as meaningful as if you had a very large sample. That's just kind of the basics of investing. Diversification is better than not diversifying. Finally, taking advantage of getting an edge from the market by looking at stocks that are trending up and avoiding those that are trending down is prudent, but is not the only way in which we can smooth our returns and increase the probability of being successful. There are other ways to diversify, such as selling covered calls. We can make this whole process a lot easier by buying ETFs and things like that will help to smooth our returns and over which we have a little bit more control even than just continuing to shop every day for a stock that's at its 52-week high. Let me give you an example. This stock has hit its 52-week high today. It was the one on the NYSE. Now, let me ask you, it did hit a 52-week high, but it's not much higher than where it was in the beginning of the year. Would you really be willing to withstand this volatility just on an arbitrary decision that, well, it's hit its 52-week high, therefore it is more likely to rise? It's really the kind of risk, and I think this illustrates the point, it's the kind of risk that's better spread out across a large pool, and it's something that we can take advantage of all of the diversification tools that are available within the market. So, in the meantime, if you're interested in finding stocks that are hitting a 52-week high or a 52-week low, if you're speculating to the downside, there's some great free tools that you can quote every day. So for example, on the NASDAQ, there's a link to that particular tool in the write-up for this article that you can check every day, and it'll show you the stocks that are at their highs and lows for the NASDAQ, the NYSE, the Amex, etc. So you can really keep your eye on what's moving out there in the market, and are there a few opportunities that I may want to add to a very diversified portfolio.